Okay, good morning class. This is your instructor Maliha, and today I'm going to be talking about what we have already previously learned, and that is pertaining to accruals and deferrals. So you see, this chapter is pertaining to adjusting entries. Now, what is the concept of adjusting entries? First of all, you should know that any change that takes place in the activity of the business has to be recorded in a system of accounts, basically, that the company has. And from that system, it produces the financial statements, which has all the previous record of the financial activities of the enterprise. So now what does adjustment mean? So this is basically what was the opening balance of, let's suppose, cash. So you have opening cash, and we have already discussed in the previous classes about the accruals and deferrals concept, and what is the opening balance, the closing balance, the ledgers, the trial balance. So, taking ahead the same concepts. So now what happens is that when you have, for instance, opening cash, that means that that cash balance was from the previous year, okay? So the closing balance of the previous year, that was the cash in hand that was left in the account, in the business accounts, in the vault, whatever. But that was their saving in cash. Then they would be using it in the next year. So the opening balance would be the closing balance of the previous year. So that is known as opening cash. Now, adjustment would mean any change that takes place. So you have to record all the changes that take place in that business. So in the activity, because of the activity, and since I have already explained to you what is cash flows, so there are three kinds of activities. We have done the financing activities, the investing activities, and the operating activities pertaining to the accounts receivable and accounts payable cycle, and how you adjust those cycles. How do you adjust something? When the status of that thing automatically changes. So for instance, if you have account payable, it is no more accounts payable because you made payment. So you adjusted that accounts payable. And when you adjust something, then that would convert into something else. So now it is paid. It's not a payable anymore. So now this is known as adjustment, right? So like I say that, okay, so this is a duster and this is a marker. So if I need to have, proper duster to clean this board. Now, it may be that this is an old duster and I would have to make changes to it. So then I can say that I have to make some adjustment in my stationery so that I can teach you better. Similarly, there could be changes or adjustment in the projector, which is actually highlighting everything that I am telling you about. Similarly, there could be some other things that need change. So basically, what is adjustment? That there's some change which is required out of the original thing, and it changes the whole outlook, the appearance of that thing, or it would maybe enable it to function in a different way than it was originally functioning. So adjustment also in financial terms, similar concept is borrowed from this idea that any change that takes place, because you see business has various accounting periods, so they have various activities that are spread over the accounting period. So that could also last up to various or subsequent accounting periods. In that case, so for instance, I give you an example of an asset. So the functioning of that asset begins when you purchase and put it into use. Now remember the definition of asset. We say that it does not get consumed, but rather it would make or produce things of value to you, and without getting consumed itself. So that means an asset would keep on working, itself. It can be without getting itself rather consumed in the process of making another thing. So it would produce a thing of value for you. The benefit can be enjoyed in subsequent accounting periods, and in this way we say that the asset can be reported in different periods, but there is a hitch. That asset is prone to wear and tear, so it depreciates. Now depreciation is basically different from obsolescence. I've already given a concept of obsolescence, that something which is not required or is in use or in demand anymore, like technology. like the Nokia 3310. It was the original. You see, the small this portable phone, but it had very primitive features like the touch. Did not have the touch screen and had big buttons. You see. So now more focus is towards the smart screens, smartphones, smart tech. So tech savvy people have increased and steadily growing in number. Then that means that that thing is obsolete now. Its use is no more, and we have to focus on other things. In that case, the asset is obsolete, and you have to write it off. But sometimes you don't directly write off the asset because it can give you, production, and it can be made use of for many periods to come, but the value slowly, steadily declines, okay, because it is undergoing the process of wear and tear. So in that case, you have to make adjustments, and one of the adjustments in that case would be depreciation. Now, as you have already, this is the process of wear and tear of an asset, and don't get me started on asset. I've already explained many times to you that it is a thing of value, economic value. It gives you production or things of value without getting consumed itself, is prone to wear and tear and can be obsolete, subjected to obsolescence, and there are many, and it can be consumed but not immediately. It does not get consumed itself, but it does not get immediately at least consumed. It undergoes some process where it would, eventually wear out, and that process is known as depreciation, and the useful life concept is associated with this. Is useful life. Now, what is the useful life actually? This is the number of years that an asset might serve you, okay? So, car for day-to business, because I told you that asset has to produce a thing of value. It cannot simply lie there, because if you own a car, that is not an asset, though you may declare in tax returns as an asset because it's a thing of value for you. But for business, something which does not offer it value for producing something as a source of income in the future accounting periods, then that is not an asset. So now, for Daewoo, the cars or the buses or the taxis, these are, buses are all assets. So now they have useful life of, let's say, 10 years. And I could say that one bus might cost you, let's suppose, $20,000. And you can say that the useful life was 10 years. So that means annually you would have to write off $2,000 written off annually for 10 years. And that is up to the accounting conventions, okay? So there are accounting conventions which lead us to depreciation. One is IAS, and this deals with, depreciation. And you have to go through these regulations. Now there are EFRS, which is International Financial Reporting Standards. They are merged with IASs after this additional need was, there was a requirement that arose because of some complicated transactions. So you can say that this has to be written off after 10 years rather. After 10 years time. And so $2,000 per annum has to be kept as a provision. This would be a provision for depreciation. It's not a liability, but it's a provision. It is something that you keep aside for use in the future because you might need this money to replace your asset after 10 years, and that is since an accounting convention. These are the principles and these are the regulations. You have to follow them, and there is no question of why, right? Because it's something that is a practice, because the firm has to keep this notion that it's a going concern. So a business has to be a going concern. You have to read this as well. You have to go through this, and it has to do with the concept of historical cost. So you have to book the asset at its original price, then it has to be written off, and when it is written off, that would be from the original price of the asset in the asset side of balance sheet. So it's going to be something like this, and would be remaining, this is this, and the next year is going to be $20,000, and then since you keep adding to this, so it's going to be 4,000, because every year it's $2,000, so now it's going to be 4,000, and remaining would be 16,000, and this thing is known as accumulated depreciation. Okay, now when you make an entry, and I've already told you the entries, but it's going to be a depreciation expense of $2,000 to accumulated depreciation of $2,000. Okay, now this basically is per annum entry. So when you have, let's suppose, subsequent periods, so you might say that this was for 4,000 and you have just booked for 2,000. The reason is that every year you make this entry. So there's going to be an addition. Next year is going to be again 2,000, so 2,000 and again another 2,000 would match and come to about $4,000. But every year you make one entry for putting this as a provision. Now when you have the asset as consumed, there has to be an adjusting entry. Okay. So I'm going to be explaining three entries to you today. One is the depreciation, the other is the insurance, and then there's another concept of revenue. Okay, we have done this concept, but I'm going to be explaining to you again. Now, what you have to see is how to, first of all, book an asset. When you initially have an asset that is, let's say, this was a car or a bus, you had $20,000 to cash. Let's assume this was $20,000. Now, this was the first entry at the time of purchase. Now, after the year end, and since every year you have to now book for 10 years useful life, 10 years useful life, you would be required to book the depreciation for 1 year every year, okay, every accounting period. So this would be 31st December in this case, and this was, let's say, 1st January. You just keep it simple, because let's suppose if the asset was purchased in the mid of the year, then the depreciation would only be for half this year, or it might be booked next year, because there's a convention where you can, the year in which you purchase, you can let go of the expense for some period of the time, and you have to book it in the next year. Okay, but leaving aside that concept, you can just see that this is 31st December. Now I'm going to be booking one expense as depreciation expense, but I have to write off this asset. So I'm going to be either writing off this bus for $2,000, and I'm going to be booking this, okay? And this is also accumulated depreciation, because I have to book this because I have to credit this bus, and this is the wear and tear. So usually we can make entry as depreciation expense to accumulated depreciation, and we also have to credit this asset. So we can say bus, and on account of the accumulated depreciation, the bus at that point is credited to this. So this is known as the first adjusting entry. Okay. Similarly, we have another concept, and that is so you would actually credit the asset when it is consumed. So when an asset is consumed, you will credit that, and you will debit the expense of that asset or on account of that. Now, so when you credit the asset, basically what you are doing is that you are reducing the cost with accumulated depreciation like this, and this is the remaining asset. Remaining asset. So now you can say that this asset has actually reduced. So this value would give you a lesser value, so that is why you credit the asset on account of accumulated depreciation like this, okay? So I hope that you have understood this entry. And now let's just come to the concept of revenue and accruals. So when you have accrued, concept is means outstanding. Now there are two things that can be outstanding. One is the income, the other is expense. There could be receipts, these could be payments. Now when this happens, so if you, let's suppose, have revenue, accrued revenue, it means that this is your asset, and at the same time you have earned it, so it's your income as well. So anything that is, this is a receivable. So when you make an entry, you're going to write as a receivable from the debtors, trade debtors to earned revenue, okay? So this is earned revenue. That means you gave the service or you delivered the goods, but you haven't received the payment as yet. So this is earned, big time. And this deals with the accounting principle of, recognition. This is revenue recognition. That is revenue recognition. And this is the earned revenue. Receivable is something that you are yet to receive, haven't received the payment for it, and these could be your trade debtors. Because with revenue, the receivable that is associated with it is a short-term receivable, and it is accounts receivable, could be notes receivable, and it is short-term within one accounting period, okay? Now this is when we talk about the receipts. So when we come to payments, now you have to see that when there's a prepaid, now something which is prepaid is an asset. It could be a prepaid rent, or it could be prepaid insurance. Any expense that is prepaid is an asset. Rent, insurance, taxes, bills, anything that you prepay in terms of expense in advance. So prepaid means advance, okay? That is advance. Anything that is prepaid is an asset. It's written on the debit side. Two, what would you actually credit? So that is something which is your cash, right? You paid cash, so now you're going to be crediting cash to it. So now, if I have to adjust these original entries, how am I supposed to adjust these? Now let's look at adjustments. Adjustment. If I receive revenue, so what am I going to credit? Naturally, now the adjustment would be that I'll write off the receivable as a credit. Because I received cash, I'm going to debit this to receivable. Because it's no more a receivable, I received cash for it. This will stand as it is because it is our earned revenue. Closely associated with this is the unearned revenue, okay? I'm also going to be coming to that. But with earned revenue is a receivable, but with unearned revenue, you have cash. Because you can't write down the entry if it never took place. So you haven't earned anything, and he hasn't paid you anything, you don't record that. You just had some chit-chat with him, you had an agreement. But unless one of the either two parties has initiated a transaction, you can't write that here. Alright? Now this is cash too, receivable, and remember this is the word earned. But when we talk about prepaid rent, now I'm going to be reversing a part of it, because after, let's say, you paid the rent for one whole month, okay, and that was on 1st of January, and you paid $100 as the rent for 1 month. That means for the whole year you're going to be paying $1,200. So for 1 month, I'm going to be reversing this thing as it's no more a prepaid on 30th, 31st January. It's no more a prepaid. I'm going to be reversing that as rent expense, because now it's an expense. So when an asset is consumed, and let me write this down, that when an asset is consumed, it converts into expense. Please remember this very important thing. It will aid you in your future transactions, understanding them, adjusting them. Now that asset could be a prepaid, that asset could be an actual property, plant and equipment, that could be your portable asset. Anything of value which can give you things of value is your asset for the use of the business, not for idle keeping. So if you own a house, it's just maybe your property, but it's for the business. Unless it is producing you some revenue in the form of rent, you can't call it an asset. Then that should be investing assets that we talk about for business. And for business, when you have property, plant and equipment, you use that premises to actually produce something. Like a factory would be used for producing cars. Similar fashion, you have consumed the prepaid part of the asset. It's known as an expense to prepaid, because now you're writing off. So writing it off, prepaid rent, insurance, or taxes. And since it is for 1 month, it's very simple. But what if I gave you for $1,200 for a year? In that case, if I give you that question where I say that you prepaid, made a rental payment for 1 year of $1,200. Now 1 month has passed. What will you do now? So in order to record when a year is given, you divide it by 12, like this. And now you convert it per month as 100, and now you're going to reverse only that part. Because this is 1,200, this is 1,200, but this is going to be 100. You're not going to be reversing the whole amount, because only 1 month's rent has been converted into expense. Now I hope that you understand this concept at least. Similar is the concept as deferral. Now what is a deferral? Now deferral means that you postpone, and in that case it becomes a liability, like deferred taxes come to about the same concept, and this is like something as a payable, accrued expense. Similarly, you have as an outstanding, so this is also your liability, and these could be something is a payable, is your liability, and it is outstanding or it is deferred. Something that was your liability and still you defer it becomes a long-term liability. If it is deferred for more than one accounting period, it becomes your long-term liability. Okay, closely associated with this is the unearned revenue concept. Okay, I'm going to be rubbing this, and hope you can see this working, right? Closely associated with this is the unearned revenue. Okay, now when it comes to unearned, it's no more accrued, okay? It's unearned. So unearned would mean that somebody paid you cash in advance, so you're going to be reporting cash to unearned because you haven't rendered your services yet, unearned revenue. And you can't recognize it, so it's unearned. But when, let's suppose you receive $1,200, you are the other party of the rent. So it's $1,200. But now for 1 month, you earned that revenue, okay? Because now the person occupied that property for 1 month. So you're going to reverse this status. You're going to put it in the opposite direction. Unearned revenue to earned, or revenue earned. Okay, so earned revenue or revenue earned. And it's going to be $100. So this is as simple as that. You won't reverse the whole thing, but up to the amount that was due. And let's just start with a few questions. I'm going to be doing 3 questions or 4 if it's possible for you to immediately connect to this concept. Let's look at this question. Now let's just move to the part. Yes. Okay, so now the LOs that I have taught you today is the purpose of adjusting entries. I already explained that. I hope that now you can see this. The purpose of adjusting entries. Basic type of adjusting entries, we have done 2 to 3 types of adjusting entries. Adjusting entries to convert assets to expense, we've done that. Adjusting entries to convert liabilities to revenue, we have done that from unearned revenue to revenue earned. Prepare entries to accrue unpaid expenses, we've already done that by, okay, so I think I have not done the unpaid part where we have prepaid it, okay. So prepare adjusting entries to accrue uncollected revenue, and that I have done as unearned revenue. And to accrue unpaid expenses, basically when you have deferred liability, like something which is payable as an outstanding. So you have is as an expense, rent expense to rent payable. It's going to be a simple thing. So for instance, you just paid 1 month's rent as $100. But for the next month again, there's you have to book the rent. It's going to be rent expense to rent payable. It's as simple as that. The principles of realizing and matching relating to adjusting entries, have done that. Concept of materiality and adjusting trial balance has to wait for the next class. Let's just look at a few questions. We'll be doing further, detailed discussion in the next class, hopefully. But this was what we discussed already. Okay, so now we have the brief exercise. The first one is prepaid expenses and unearned revenue. On November 1st, Petrie Corporation purchased a 6-month insurance policy from the Events Agency for $5,400. Now, as I told you, either they would give you a whole year's policy, rent, insurance data, or they're going to be giving you for 6 months or monthly, but you have to convert it according to the requirement of the question, okay? So now they say that you purchase an insurance policy. Naturally, if you purchase a 6 months policy, then you have made payment in advance of 6 months. So prior to the use, you make the payment in advance and it's your asset, even though it's an expense. But till the time it is not converted, till the time it is unconverted, you call it an asset. It's a prepaid expense, remember this. Now part A says, prepare the necessary adjusting entry for Petrie Corporation on November 30th. Assuming it recorded the November 1 expenditure as unexpired insurance. In this case, You have to look at the dates. So first, November 1st. What is the requirement? November 30th. How much time has lapsed? 1 month. Now that means I have to divide this by 12. Divide it by 6 to find out what is the monthly rate. Let's just calculate the monthly rate. And that is 5,400 by 6 comes to about $900. Okay, this is $900. Adjusting entries, you will get recorded expenditure as they have already assumed that you recorded the first entry. What was that? Unexpired insurance, prepaid insurance to cash because you paid cash. Now you are to make the adjusting entry, not the original entry. Now I'm going to make changes to this. How? I'm going to be reversing the original entry by recording the insurance expense to prepaid insurance. How much? $900. Okay, and then you can just simply write reversal of prepaid. Just some explanation for the general record or for the general journal. You have to make sure that the formatting is correct. Now part B says that you have to prepare the necessary adjusting entry for the Evans and Agency. Okay, now there are two things. One is the Petrie Corporation. You are the Petrie Corporation. Evanson is the one who received. So when he received something that was in advance, the original entry was cash to unearned revenue. When he reverses that, it's going to be unearned revenue would be debited by $900 to earned revenue. Earned revenue, $900, okay? So this is basically cash to unearned revenue. And it shows that you made the entire payment, but after 1 month, you earned part of it because 1 month has lapsed. Now let's just move on to the next brief exercise, and it says that Williams Storage agreed to rent Haka manufacturing warehouse space for $4,000 per month. And he paid the first 3 months rent in advance. Obviously, this is $4,000 per month, and he paid the first 3 months is going to be $12,000 after 3 months advance. So it's going to be like $12,000 prepaid to cash. Okay, so it's just similar thing, just the name has changed, the nature of the expense has changed. They're asking you to prepare the adjusting entry for Haka, someone who rented. The Williams Storage agreed to rent, so they're asking you to make from the point of view of the one who rented, and they are also going to be asking you from the point of view of someone who received that money. So Williams Storage was the one who agreed to rent their warehouse to Haka. So in the first stance, Haka was the one who paid. Now when you make the entry for Haka, you know that they made the prepaid thing on February 28th. So that means 1 month exactly. So for prepaid rent, you have to make the reversal for prepaid rent as $4,000 for 1 month, and rent expense as $4,000. That is from the point of view of Haka. Part B would be from the point of view of the recipient, that was Williams Storage. Okay, so this was Williams Storage, and they are going to be from unearned to earned. So earned rent. So it's going to be unearned revenue, rent revenue of 4,000 to earned rent revenue earned, and it's $4,000. Okay, let me just give you a rundown. Rent expense to prepaid. You reverse the prepaid. The original was prepaid to cash, the whole amount for 3 months, 12,000. After 1 month, it's going to be converting the prepaid to expense after consumption of that period for rent. They occupied the space for 1 month. And then this is the part where the other person has to record his entry, his side of the story rather. So it's going to be unearned rent revenue is reversed, because what he actually got was, when you made a prepaid, he got the unearned. So it was like cash to unearned. So the prepaid is actually unearned, and it was cash to unearned. Party A and party B. Party B is Williams, and that is Hecka. So Hecka did this entry, and party B, the Williams company, whatever it was, they received the cash to unearned. But then they're going to reverse it for 1 month and record that they earned this. So this is basically summing up this question. Let's just move on to the third part. Now this part says that you have this supplies on hand. Cyber Corporation had office supplies of $2,500. During the month, Cyber purchased additional supplies costing $4,500. So now supplies account, the working is going to be, it was 2,000 opening balance plus purchases, whatever the purchases were. This was opening. This was purchases as how much? Purchase additional supplies costing 4,500, okay? And approximately 3,000 remain on hand at the end. How much does that become? So it's 001, oh sorry, 000, and 4, 5, 6, 7,000. Now closing balance is actually subtracted. So you subtract the on hand means it is unused now. And we don't want the unused part, because we need to find the adjusting entry for supplies that have been consumed. So they say that prepare the adjusting entry to account for office supplies. So if he had opening supplies, he purchased additional supplies, and the unused supplies remain. And so we don't want that, we just want that whatever is consumed. So initially, first of all, how much was the total supplies? This was, and after the unused supplies, so this was, total was this much supplies, okay? So this was the, when he purchased the supplies, it was supplies to cash. This was the opening balance. And if you make a ledger, you will see that this was 2,500, and you had further 4,500, and this was 7,000, and closing balance is okay, yeah. So the total was $7,000 in this case, but then there was something which was closing, and closing is shown here. Okay, so this was the balance that was not consumed, rather it was left, and it's always on the other side, so this is carried down, and this would be brought forward to the next year. Okay, the remaining supplies have been consumed, so this 3,000 is subtracted, and you get approximately $4,000 worth of supplies left. Now you can say that office supplies initially were $7,000, and you had made the first entry, office supplies to cash. This was office supplies to cash. Now, but then some of them were used office supplies and they are converted into expense. So now they have to be credited because they are no more expense. So when you write off something which has been consumed, how do you know that it has been consumed? Because they tell you that this is unused. Indirectly, they are telling you that remaining was used. So if they give you a transaction where they tell you that it is unused, you have to subtract that as a closing balance. The remaining was used. How much was used? $4,000. So the entry is office supplies credited. Okay, so this was about $4,000, and supplies used, consumed, or used, 4,000. This is converted into expense. So when an asset is converted into expense, this is through the process of consumption. I would end my lecture here, and we're going to continue the next time around with some kind of an example, case studies, and then we're going to be further delving into what is accrual, what is liability outstanding, and I'll just see you next time with these concepts along with the demonstration problems and then income tax, the final adjusting entries. So we're going to be doing also sort of like attempting the problem with the trial balance in hand. I'll be showing you the original trial balance. We'll be doing some adjusting entries in the problems. So that's about it, class. I hope that you could understand the lecture. And it's signing off for me.